Every property owner in the United States of America is required to pay property taxes. It doesn't matter what type of property you own, whether it's a single family home, multifamily property, commercial property, a restaurant, a piece of dirt in the middle of nowhere. The counties use that property tax to pay for most of their expenses, things like the schools, teacher salaries, bus drivers. It's the most important source of revenue that they have. Your property taxes are based on the value that the county thinks that your property is worth. Every year in the mail, you get an assessment where the county says, this is what we think your property is worth, and your tax are going to be based on that valuation. You probably don't even know that you're paying property taxes if you have a mortgage on your property, because your mortgage company includes your property taxes in your mortgage payment. They hold on to that every single month, and when taxes are due, they send that payment to the county. And they do this because if property taxes don't get paid, the county government is going to aggressively come after you as a property owner to make sure that they get those paid. Unfortunately, every year, about 20 to 30% of property taxes go unpaid. And this puts the county in a very terrible situation because they don't have the revenue that they need to pay for the services that make the county work. The counties, in order to fix this problem for them, came up with something called tax lien investing. Now, when a property owner doesn't pay their taxes, the county is going to create something called a tax lien. Over time, we've discovered that most taxes end up getting paid. So the problem isn't that the county doesn't end up getting the money. It's that the county doesn't get it now. So by creating tax lien investing, the counties solve that problem of not getting their money immediately. Now, before we get into the details of tax lien investing, I want to talk just real quickly about liens, because that is at the very foundation of what we do. So when a property owner buys their house, generally, they're going to have something called a mortgage placed against the house by the bank. Now, it goes in what we call first priority or first lien position. What this means is when the house gets sold, the mortgage is the first lien that is going to get paid off. Now, a couple years later, let's say the property owner decides that they want to tap into some of the equity of that house. And so they pull off something we call a home equity line of credit, which just lets them have some of that equity. Now, a couple of years later, they decide to add on, maybe build a deck, maybe build a pool. They hire a contractor, they do the work, but for whatever reason, they get into a dispute and they don't pay that contractor. So the contractor has a right to put on something we call a mechanics lien. So when the house goes to sell, they are going to pull from the proceeds to pay off that mechanic or that mechanics lien or that contractor. This is what we call first in, first out. Now, because the government gets to do whatever they want, they don't obey this process. So when the county creates a tax lien, they don't go into fourth position. They prioritize their lien over everybody else's. So they create a tax lien that actually goes into first position over everybody else. They don't obey the first in, first out principle. Now, when they create that tax lien, it's not only a tax lien, but it comes with a penalty. Now, that penalty is going to vary from state to state to state. Some places like Florida are 18% interest. Arizona's 16% interest. Now, I don't know about you, but as a real estate investor, that number makes me really excited. There's not a whole lot of places in real estate where I can make 16, 18% rates of return right now that is secured by an asset. So when a county creates that tax lien, they don't auction off the lien, they auction off something called a tax lien certificate. So every county is required by regulation to create a list of all the tax lien certificates that they're going to make available. Now, most counties do it online. Some counties, though, they're still old school and they'll put it at the courthouse or the county office and you have to go look at it. But they're required to make public that list of tax lien certificates that they're going to auction off. Now, let's look at an example. So I've got a property in Florida here as our example. The taxes that were owed were $1,000. But the property owner, for whatever reason, couldn't pay. It could be a lot of different reasons. And instead of the county just coming and saying, we're going to foreclose and sell your house, in Florida, they create the tax lien that goes in first position, and they create a certificate. that they're going to auction off to anybody that wants to buy. Could be you, could be me, could be any other investor. And they're going to establish that they want their $1,000 and they want that problem solved immediately. So pay us the $1,000 immediately, and I'm going to come in and I'm going to buy the certificate for $1,000. Now the penalty is going to be at 18% interest. Now the reason that they do that is that they want somebody to pay them off now. They don't want to wait for the property owner, who is eventually most likely going to pay them. But it could be weeks, could be months, could be years, and the county wants that money right now. So in order to incentivize somebody to pay the taxes on their behalf, they establish a really high penalty, in this case 18%. This creates or solves several different problems. It solves the problem of the homeowner so that they have time to pay their taxes. It solves the problem of the county because the county gets their money now, and it solves a problem for me as an investor because I've got a chunk of money that I want to invest at a great rate of return, and it gives me an opportunity to make an 18% rate of return in the state of Florida. All right, so be sure to watch the next video, because in the next video I'm going to show you how you as the investor get your money back plus your profit.